Hey, everybody. Welcome to our webinar today. Retailers are doubling down on returns. My name is Greg Busick, and we'll be leading things off today. It's a little harried here today with the weather coming through. We've had tornadoes for the second time in 3 days. They've come right over our house, but not touchdowns. Really interesting evenings around our place. I'm just going to have the guys introduce themselves. Go ahead first, Shashir.
Thanks, Greg. Great to be here. I'm Shashir Saha. I'm the Senior Product Manager for Sterling Auto Management. We are having wet weather here in Central Texas as well, but nothing as exciting as tornadoes. I hope everybody is safe at your place.
Yeah, no, everybody, it seems safe at our place right now. Yeah, for sure.
And I'm Lee Holman. I'm in South Florida, so we don't have to worry about hurricanes for another couple months. So
Sounds good. Sounds good. All right, guys. Well, the chat is open. Tell us where you are. Who do you got left? I've got my Auburn on left for the game. Tell us who you're rooting for. How are your brackets doing? All that sort of stuff. As always, we'll have the slides and the report at the end that you'll be able to get. And so let's just get going. Internationally, what's going on? Basically, there's a variety of different things happening. Germany is seeing retail sales up. Even though the country itself is struggling towards recession, retail sales have been up. In the UK, things were up still 1% in January. France down. Spain continues to be up, remains the star of all of Europe in terms of growth. Italy continues to be up. They've been up every year, or excuse me, every month on a year-to-year basis since March of 2021. They continue to grow. Poland is down 0.5%. They had a really strong January. They went up 5% in January, and then they went negative. So I think there's a little bit of timing issues in play. Hungary, 12 consecutive months of growth. China, 4% growth. India, 5% growth. Grocery driving most of the things there, 2.3 times that growth of any other sector. Japan, 3.9%. South Korea flat, which is really interesting when we get into this whole tariff discussion for South Korea. There really hasn't been a positive month for quite a while. Ever since they had that presidential turmoil, things are really been up in arms. Vietnam continues to be the star. That is the one that's really up for grabs when we get to talk about tariffs, because so much of our clothing and apparel got switched over to that area. Australia up, Mexico continues to be up, and Canada up 4%. Now, mind you, this is all before all of the things that have been happening most recently with tariffs. So where are we with inflation, or where the government says we are with inflation, is 2.8% for inflation. If you look at the individual items, eggs is what's driving mostly anything related to food, inflation growth there, with a few exceptions. In other areas, it comes down to insurance and repairs being the key driver for most anything in the actual inflation gauge. When we look at things from a perspective of the CPI, what's interesting is if you look at this, the have tos, things that people have to do, the inflation rate is 1.5%. We're actually below the 2% that the Fed was targeting. And then if you strip out shelter, and the reason I say strip out shelter is not that people don't have to live somewhere. There is a made up factor that is 40% of that measure for shelter that is behind by 6 months. And it's also a made up measure that they think, what can you get for your house if you were to rent your house? It's not even a true measure. It's what they think you can rent your house for there. And so if you strip that out, it's actually 1.1%. But overall, the have tos, the things you have to do, we're below 2% on. That's also reflected in Truflation, which is my favorite measure to look at inflation. It's the Nielsen ratings of inflation, and it has the market basket of what's going on and the things that you can really see. So you can go back and look at any measure, et cetera, what's going on with Truflation there. Now, I did bring in their eggs index because that is one of the things that everybody's concerned about, and eggs are dropping. I'm not sure they're dropping as much as the president said yesterday in reality when it comes to the actual stores, but they are dropping from the highs of where things were. Now, for some better news, is gas prices are down about 40% a gallon, not only in the passenger car side, but also on the diesel side, which is really important when we start looking at tariffs and all this discussion of tariffs and cost of goods, because that diesel price factors into the cost of goods. And this is a positive that we get to work with when we start factoring in what is going on with all these tariffs and what's the impact of that. Hey, if you used our tariff calculator on April Fool's Day, let us know in the thing, because we don't really know how many people actually used it or how many people we got there. But that was a lot of fun to do, to put together a tariff calculator. But I'm actually going to try this time and just, instead of saying April Fool's there. So how did we get into this situation? Well, the problem is our debt. This is a reflection of our debt. We're spending $2 trillion more every year that we're putting in than we're taking in terms of revenues, and it's just not sustainable. So we've got this period of austerity that is creating some massive angst, as you can imagine. And the stocks, I didn't even look at the market where we were at the moment right now, but I think it was down 700, 800, 900 points going into the day. I'm sure it's probably not as bad as that, but I could be totally wrong right now. I have not looked at it. So what got announced yesterday, these are the major trading partners other than Canada and Mexico, what the tariffs are. And this was the chart. There's like 5 charts that he held up. I just went through and looked at the major trading partners here. And a little bit of backstory. There is an incredible book called, from 2014, which is amazing there. It's called The Accidental Superpower. And in a nutshell, after World War II, the United States basically opened up our markets and said, hey, we'll protect you as well during this process of rebuilding. And that was in Europe and Japan. It seems like every place that we've gone where we've had wars, we have basically said, no, we're going to help you rebuild. And so we helped everybody rebuild after these wars, other than China, of course, and Russia. We had done, we'll play the role of protector in a lot of places around the world. What happened is those tariffs just became part of the nomenclature for those countries over time as they've rebuilt. And now our debt is happening. So where our debt is growing, that is where we're getting into this problem where we've got to raise revenues, whether that's taxes on individuals or whether we do that for external people. That's kind of the justification. Don't want to get into all the politics of it, whether you argue with it or one way or the other, but that's the background. By the way, our president does a horrible job of explaining things. I will tell you that Howard Lutnick, who's like the architect behind that, he did a podcast with the All In podcast guys about 2 weeks ago for about 1 hour. He does an excellent job of walking through all of this and what the reasoning is and how they're really thinking about it. And that's kind of getting lost in translation with all the publicity side of things. So highly recommend, if you're really, really interested in that, go listen to that podcast. It's excellent. So what's an example tariff simulation? So we put this together this morning. This is part of the reason why I'm so discombobulated at the moment putting things together. But tariff simulation, everybody just assumes, and all the talking heads say, oh gosh, if it's a 20% tariff, then the prices are going to go up 20%. It doesn't work that way. It doesn't work that way for retailers. Okay. The reality is that only about 75%, and this is a mass merchant example, only 75% of the cost of goods is actually the product itself. It's the cost of getting the product to where it needs to go. That's the other 25%. In fact, when you look at other segments like fashion and other things there where you've got light product to ship versus, packaged products to ship, it's actually a higher proportion of things that is related to product cost as well as the distribution thing. So there's scenarios, and you can run scenarios all day based on what's going on in terms of the segment. But the assumption in this is that 75% of the cost of goods is the actual product cost. The rest is distribution costs, which are actually coming down, but we didn't factor any of that into to this. 80% of the products being sold are imported. That's for a mass merchant, that's about correct. Okay, most of them come from Canada and Mexico. And then you have China in the case of the US. Overall, if you have a blended rate of 20% here, that's what we're factoring into this example. So when you look at a typical, on the left side, the standard P&L, for a $1 billion mass merchant is about a 3% net profit margin today. So the next column over here, this column right here, if you have a 20% tariff and that retailer absorbs all that cost, they go negative to a minus 4.2%. Just not reasonable. It's not going to happen there. So the other thing is what happens if you pass those all on to the customer? What is the price increase? It's not 20%. It's 7.2%. Because once you factor in that most of the costs are fixed, they're related to sales and general administrative expenses, those don't go up, or they may go up slightly because you may have some import or input items into some of that stuff, but generally it's not going to go up. But it's just that core piece. So it's that 80% of the cost of goods number is the only piece that's being affected. So it's a 7.2% increase to maintain the same profit margin. So what that means is a $5 item goes to $5 and you go on up in terms of the cost. Now, if they're able to push back on the supplier to eat part of it and charge the customer the same and maintain that profit margin, it's a 3.6% increase in price. So the $5 item goes to $5.18. We've been doing that for years right now, and it wouldn't be much of a blip in a lot of cases. And if you do a three-way split where everybody takes their piece of it, that net profit margin goes down considerably for the retailer if they do that, but it's only 2.4%. So I believe these two right here are the most likely scenarios, but that just gives you a background of what it really is if it's a 20% tariff. I'm sure you're going to have questions on that. We don't have time to go into all of them right now, but we'll do them at the end. But I just wanted to go over that and provide that for value for you guys, because all the talking heads are talking about is, 20% here, 50% here, 70% here. It doesn't work that way because it's only a small portion of the actual pie of what does in operations there. So now let's talk about the consumer themselves. Where are we? Percent of our actual personal spending that's occurring right now in a retail environment is actually the top 10% of incomes, where inflation is discomforting, but it's not the end of the world for those people. It's the people that are in that $50,000 or below income where this really hits hard. And this is where we're starting to see some real cracks. Our overall credit card debt is up considerably. Most specifically, the interest rates have jumped from 14.3% where we were prior to the pandemic to now 21.47% there. That is turning into delinquencies. Loan delinquencies are way down. Mortgage delinquencies are way down, even though the costs are huge. But the student loans piece of things and auto loans are the two areas that we're seeing upticks, and people not being able to pay their bill. That has led to car repos that are up 43% as a result. And then you factor in the auto insurance rates and the housing piece of it that we're going to get into. Our mortgage rates for an average home, the median home, the amount of money you spend for a mortgage rate has doubled since November of 2020. We're up 99, January of 2020, up 99%, the average median home. And that affordability gap is separate. So why do I bring this piece up? This is the most critical piece here, is what percentage of the median income is required to afford a house today. The reason that's so critical is when people move into houses, they spend money to put furniture and decorate and buy new plates and do everything else. And that's obviously all retail spend. And so one of the things that's happened is that first-time home buyer, who is the one that needs everything, they're not in the market, and we're at the lowest of all time for first-time home buyers there. That's probably a bigger threat than the tariffs, as well as the debt to retail specifically, is this change in the rising price of ownership. And so we've got to build more houses, and we've got to take a hit on the housing prices to get back to that affordability so we can actually be spending more money in the United States on retail from the housing perspective. So where are we with retail? So a little bit of background, just for a reminder, we actually added India's total retail sales to North America retail. We added that in 2021 as growth. And then we continued to grow in 22. We added the UK in 2022. In 23, we added Poland's total retail annual as growth. And then in 24, we still grew 1.2%. And we did that with a lot fewer employees, as you've heard me maybe say in the past. So retail continues to go up. And despite what you've heard, for the first part of the year where everybody's screaming retail sales are down, we're actually up for the year. And we were up in January and February if you compared the same month a year before. I don't know about you guys, but I wasn't shocked that retail sales went down in January over December. I don't know who is shocked out there, but that's what the headline goes out. And then we had the weather and the fires and things in January that impacted the January to February piece. But believe it or not, in both cases, we were up year to year. It was just those month to month numbers that changed. Now, that being said, on an inflation basis, we are down for the year when you add inflation into it. So even though our inflation rate is down considerably, our growth rate is not enough to overcome that difference with inflation. So that brings us to the crux of our webinar today, which is really on returns, and it's the growing crisis of those returns. So the report, we've got a report that's out there that we'll make available here at the end. So how big of a problem is this? Returns this year in 2024 went up $100 billion worldwide, $1.9 trillion in global returns worldwide from our research. The scariest part is it's outpacing the rate of retail growth. 91% of retailers say their return rate is growing faster than what they're actually seeing in actual sales increases. And a big part of that is e-commerce returns. And we'll talk about all these reasons. As I mentioned, particularly the online sales growth. When you use aspirational sizes rather than using true fit technology, and everybody's size 8 cocktail dress is not a size 8, it's a size 2 at one retailer, it's a size 12 at another retailer. We have no consistency. That is actually just creating horrible situations when it comes to returns. So what happens? A lady buys 3 or 4, keeps 1, sends the others back. The retailer is eating that cost. Second, the consumers are expecting free returns. They change their buying behaviors based on whether or not you offer free returns. And then finally, return fraud, the scourge of our industry, is back and getting more sophisticated as we've gone on. Apparel returns is a huge problem. As I mentioned, $52 billion in North America alone in 2024. That's more than the annual revenues of Kohl's and Macy's combined. Just a huge problem that we're dealing with. So specific sectors, we talked about apparel being a major issue, but we've also got issues with fraud schemes on electronics. Hey, let's get a new TV for the Super Bowl, and then we take it back. So it's that type of thing that's happening out there with electronics. Then we also have it when it comes to home goods and furniture. You've got specific problems with delivery and handling, and how do you deal with things related to that. So those are some sector specific things. And then we have hidden costs that are in place, which is if you haven't optimized your return process, if you're only optimized for moving forward and not retreat, so to speak, there's a whole lot of inefficiency in the process. With the restocking piece, there's a lot of product that just simply gets lost when it's returned because it doesn't get into the right place to be resold. It's not put back in the order management system to be available to be sold, et cetera. And we'll talk about some of those solutions. And then there are major problems with many retailers in terms of the chain of custody, particularly for high value items, and who's got it at what particular time, where is it? And a lot of things just happen to get lost after they're returned. Then you also have the legacy systems problems. You've got aging systems. I mean, it's the same problems you have with AI, old systems that are in place there. And the bottom line, and we'll mention that later as a final say, is that we've seen optimizing the process cost of returns, you can recapture about 75% of it if you optimize that. And we're going to talk about ways to do that. Next is fraud. Over $100 billion now in the North America alone for fraud. Our number includes restaurants here. If you look at overall cost of returns and retail fraud, that's up even a little bit higher for some things, depending on how you calculate it. But bottom line, $100 billion, and that represents about 8 to 11%, depending on the segment itself, of their revenue is eaten up by just returns. That's the fraud part of returns. So out of their returns, which is about 17%, which is literally 1 in 6 items is being returned. In fashion, it's like the 3 are being returned if it's purchased online. But the fraud piece of that is about 8 to 11%. Now let's look at the fraud. It used to be, people would just come in and they would, return, steal something from one place and take it to another. It's getting a lot more sophisticated now. So we've got one of the key things that's happening is people are using AI to create fraudulent return labels. Actually, I saw yesterday the new Chat GPT that came out 4.0, and it's now does really well. People are mocking up receipts, just telling them hey, here's my receipt. I want you to change this to that so that I can return that information there. Wardrobing, obviously, that's you got a lot of social media people helping to drive that kind of fraud. And what's interesting is counterfeit returns. In fact, when it comes to high value items, up to 15% of those returns are actually deep fake counterfeits of the product and not the real product. So it's good enough to pass the inspection for the clerk, but it's not the actual product itself. So we've got AI is being used in a lot of different ways now: fraud detection, validation of the product, policy enforcement, being able to not just easily override those issues at the point of sale. Then you've got to factor in, beyond the fraud, we've got a 40% increase in labor cost and shipping cost in the last several years as well. All of that leads to margin drain. And that is the big issue, particularly when it comes to department stores and specialty stores, because of the level of online purchases. It's about 6 points of overall margin, of profit margin, that they're losing when they haven't optimized their returns process. So by being able to do that, optimizing that process, you can do more. The sustainability is also a huge problem. As I mentioned, 17% of everything is returned right now in North America. To put that into perspective, that's the equivalent of the carbon footprint of 3 million cars. That is the cost of return from an environment and sustainability standpoint. And with that, I'm going to take a breath and invite Shashir in to talk a little bit more about some case studies.
Thanks, Greg. Great information leading up. I mean, we saw that the rate of return is like at 17% of the total. So essentially, what I wanted to share quickly is one of the case studies. This is from one of our department stores, client from the UK, and they were looking at how to optimize the inventory and the processes in itself. Returns wasn't on their top priority, but when we went in and we looked at the data and we understood where are the opportunities, returns came back as one of the key factors, right? So essentially, what we were looking at as challenges is their stores, their different stores, they had different levels of inventories, had excess stock, whereas others were going out of stock. And that discrepancy caused a lot of vendor returns, right? Truck shows up, there's no more space, it gets returned back, whereas it could have actually been sent to some other store, right? It just adds on to these processes, delayed shipments, unnecessary returns. And then while that is from the inside part of the house, from reverse logistic outbound part of the house as well, you see that there are different orders getting returned in different places. They are out of, misplaced inventories. So that leads to a lot of markdowns and loss and liquidation kind of a thing. So these are the kind of bottlenecks that we faced, that we saw. And essentially, the solutions that we put in really optimized on the inventory visibility in terms of both how the incoming inventory is, where it should be placed, what is the, how should I segment it? How should I actually ensure that the stock levels are at the right place? And then when the products are getting returned, how do I automate those flows and ensure that it's first sent to the right location for processing, not just factoring in how the returns are being processed to put back on shelves, but also the propensity of them being sold at those locations instead of their traditional workflows of going into a centralized DC and then getting distributed out. This really enhanced both on the profitability for resales as well as store performance. Like stores were happy turning around inventory that they didn't start off with during the day, but now they are making sales out of things that are coming back in. Third, one of the use cases that I wanted to just pepper in with Greg's presentation.
Okay. The resale market is booming, and according to ThreadUp, 11 times faster than traditional retail is right now. So the used products go up not only in cost from a fashion perspective, but other things as well through these online marketplaces like Facebook. The fact that you're reselling things at a much higher rate now, part of that's economically, but also as well as just the opportunity to resell as a business is also one of those things that's out there. So all of those play a factor into what's going on with returns and the cost and the impact. So I'll turn it back to you, Shir.
Yeah, thanks for that. I was actually answering a question on chat, but this is a great segue, right? The question from Jeff was, who are the buyers for these resale inventory? And essentially, it's all about e-commerce, and traditionally, they have been liquidation stores, they have been consignment stores, but as Greg, right, as you were pointing out, there is a bigger opportunity that we've seen in many of our customers, especially in the luxury retail segment, where vintage is back, right? There's a great demand on vintage products. Sometimes there are products that are, coming back in. They have more demand because that's that one unique product that you will never get. And that market is huge at the moment.
Yeah.
But that also is tied specifically to luxury brands where the products are meant to last forever, and their value like appreciates after the fact. Customer behaviors are changing. They are open to these, vintage products, vintage styling, and things like that. But it also brings a good, brings the focus on circularity as well as sustainability, right? Where the products are meant to last long, but once you are returning, how can they be refurbished? They can be, repackaged and sold in a community which is accepting all of these things. So when we talk about refurbishing, it's all about how the status of the inventory is actually changing. It's an open box item, it's a redesigned item, repackaged item, it's a vintage item. All of those things are getting, all of those statuses are becoming more and more. We are seeing new statuses coming up this way. Reloved is a campaign that's just run by one of our top luxury retailers. Now, what we have seen is from the products that are coming in, like 27,000 plus products are being repaired with just in North America. And these are getting resold back into, into the industry. And the way that we are able to help here is how we are able to automate those workflows, make sure that there is a pipeline of products coming in, statuses being updated as and when a product is changing this, getting the status change from QC to refurbished to open box and all these areas now, and that really tracks the product all the way from its circular journey back into into the economy. That helps in both getting increasing profitability as well as showcasing and helping out in the sustainability goals for these customers. So this is like the opportunity space that we were seeing and when we were working with Greg, right? And that's where we wanted to understand what is driving interest in these, returns and circularity kind of use cases, correct?
Yep. So one of the things that's happening is that is really helping to optimize things is, let's say you have a product that you sell online that gets returned to a store, and that's a moving to the first out approach. So that product comes back to the store, it's able to be resold. So the next order that comes in is sent directly from the store back out to that customer. Because what happens is it avoids the sending it back to the local warehouse to ship out again. So this first out approach to returns at the store is cutting out basically half of the shipping cost in most cases, and that is saving millions of dollars annually, reducing the cycle time that's there, and you certainly have the sustainability piece of things that benefit by not having as many shipments there. In fact, one of the other things that's happening is, do you return at all? And we had in the future of returns, they had a story from one retailer that basically said, if it's below $25, we're not going to accept it back as a return, because by even letting them keep the item under that, they were able to save $2.8 million in shipping and processing costs over and above the cost of the product by just allowing the customer to keep the items there. And that being said, returns are best attacked by preventing them in the first place. So what are some of the technologies now that are really starting to impact things? The fit technology is having an incredible impact on fashion, a 30% improvement literally in 90 days, according to Future of Returns, with a single retailer. The ability to do augmented reality try-ons for things where you get yourself a virtual model, so you get to see what you look like in it. That is also reduced returns, and then doing a much better job at descriptions as to whether things are, and even alerting if this product is highly returned. Where Amazon is doing that now for several products, they're actually putting on this product is often returned. And so all of those factors are coming on with technologies that are improving it. But really where we're seeing a huge impact is in order management. And I want to bring that back so you can talk about that once you share.
Right. Thanks. Right. So, like you were saying, right, it is really important to have the right platform in, and order management is the place where you get to touch all these different systems, right? Where your incoming inventory and inventory coming back in where it shouldn't be. And the way we are handling this problem space is essentially helping out with circularity for sustainable returns, right? Enabling all these different use cases that we talked about: resale, refurbishment, recycling of all these different products, in opening up new channels of sales, reducing waste into from going into landfills. Very important in both retail as well as grocery sectors. Talked about how first in first out inventory from a returns perspective, and the way that we are doing this essentially is using AI in not just ensuring where the inventory is placed at the right time, but also when it's coming back, it is going to the places where it can be resold and preventing a markdown or a liquidation area. dynamically allocate these return processing areas and provide the view of the real-time view of inventory across all channels. So you are able to find that inventory as soon as it comes back and gets received and QC'd back into your warehouse. Now, when I'm talking about that workflow of changing the inventory from incoming inventory in transit waiting to be returned, there is a lot more automation that we've put in essentially in your RMA authorization as well as return generation. How would make it easier for customers to first deflect and then accept returns, right? When you can deflect, you make sure that the product is not returned in the first place. We talked about areas where we can let the customer keep or return it to a centralized location, and then the last mile of from processing it to a different store comes in, or returning it to the store where the demand is actually high. Streamlining all of these restocking and disposal, making sure the statuses of the inventory is tracked at each time of the item status changes, and all of the sales channels, including the e-commerce new sales channel that we are able to power now, has the real-time tracking of those inventory. And all of this finally leads to the seamless customer service, which enables these smarter recommendations and returns capabilities, updates on where the returns are, and integration with these refund and refund and fraud process units to actually first understand if there's a fraudulent return versus making sure that the good returns are being refunded on time. Just simplifying the entire exchange. There, even when we are trying to close the loop on the products coming back, there is a lot more optimization that we are able to do with our solutions at Sterling Auto Management.
Super. So we're seeing an evolution of order management systems where it used to be one where it was just a basic order taking. We're going to capture that order. What's the status of the order? Basic reporting. We moved, driven a lot by what happened with COVID, is the cross-channel visibility. Where is the stock? Do I have the stock? Do I have a centralized view of things? And now we're migrating more towards automated workflows. Do I keep the items? I think I've got AI integrated with what I'm doing so that I've got cool strategic decision support as part of the process so that I can get to a fully optimized opportunity. So bottom line, as we mentioned earlier, you can save up to 75% of the process cost of returns by optimizing those processes. And the decisions have now become things related to, hey, are we going to reject this return at all because it's fraud, or it's past our policy, et cetera? Do we keep it? Do we let the customer keep it because it's not worth the cost of that return? And if we do accept it as a return, where do we go with it? Do we restock it? Do we send it back to a warehouse? Do we send it to the manufacturer, or do we send it to a liquidator to be sold? All of those are part of the process there. And that's it for our core material. So I'm going to turn it over to Lee to come back on, and we're ready for questions and answers. Lee, if you could if you haven't already, drop the slides and the report links into the chat there for people if they want to go ahead and download that material now. But we'll also send that out as a follow-up as well. All right, I'm going to stop sharing the screen and get back.
This one is based on a comment that Verlin made in the chat. It seems that returns are somewhat of an afterthought for retailers. What are the best first steps for a retailer to take in terms of addressing their returns?
You want to go?
Thank you. I think we'll get used to this. But yeah, it's a great question. I mean, how do we start that conversation? Essentially, the first thing that you would want to ask is, we are seeing 70% return. Are you, higher or lower than that? How much money Are you actually spending all of this? The way it's been looked at from accounting and financial perspective is in that cost of goods sold. There is a factor of returns already baked in, which says that this will be the write-off, right? This is the cost of doing business essentially from the business perspective. And even if you're, depending on who you're talking to in the business, even if you're talking to the head of technology, that is the amount of money up for grabs. If you can show that you can utilize that money, get the money that was already written off, save certain bit of it, that can go back into the business into doing things at the periphery, at the edge and the bleeding edge. So that is this, from accounting perspective, that right of that 17 to 20% of returns that you're doing, depending on where you are in the industry, that is the opportunity space that you can play with within your companies and say that, even though you are writing it off, can I save you even like 3%, 5% of it? And that goes back into the business, and you control that depending on, how much you are saving. So that's how we approach the conversation.
Okay. I'll try and sort through the tariff questions here.
Afraid of.
Okay, then hopefully this one can help there. What do you see as the short-term and long-term impacts on the U.S. economy as a result of proposed tariffs?
Yeah, I think it's going to be interesting because it's a country by country basis for things. Vietnam has had such growth for things there. It's like part of it is almost like, oh, we charge the government, we charge the US this much. We almost like we forgot about that. Let's just get rid of tariffs because, when it comes to fashion, that just would destroy their entire economy. So I think they're making a decision there. I think Israel has also come on the record to say they're going to eliminate the tariffs or reduce the tariffs for that. Others like China, I just got a glimpse of it, is they're doubling down on things and making big claims on what they're planning to do. And they outline steps for what they're going to do there. I think, short term, anytime you have austerity, it's pain. I mean, we are addicts. At the end of the day, we're addicts to cheap goods. We created a situation for cheap goods, and this is sort of an intervention. And we've gutted the middle class by our addiction for cheap goods. And to get manufacturing back and the national security piece to start attacking some of the debt, you've got to take these measures just the same way you would have to cut back on your spending if your credit card bill was out of control. Short term, it's not going to be fun. It's not going to be fun. I think you're going to see a lot of negotiation. I think you're going to see the Mexico and Canada thing die down a bit, as there'll be exceptions on the big products. I think if you go to that All In podcast, highly recommend it. It's one you don't have to put on fast forward or high speed because he talks so fast. But you get a broad picture of kind of what they're trying to do, and basically, and it goes together with Doge. And gosh, I don't want to get into all the politics of it, but basically Elon was tasked with finding $1 trillion in savings. Howard was tasked with finding $1 trillion in revenue there to attack this differential between what we're spending and what we're taking in for revenues. Long term, I think the tariffs are meant to be a way of keeping taxes low or providing tax cuts. We didn't have income tax before, I think it was 1905. Everything was tariffs. And then we had a couple wars and all that stuff. And now income tax is everything. And I don't know why, the number one thing I would do if I was them is on Social Security. I'd shore up Social Security by removing the cap on earnings for Social Security. It makes no sense that high earners don't pay into Social Security anymore after a certain level. You may not want to have the companies pay that type of thing, but high earners should just continue to pay in it, even though they're not going to get the benefits of it. That would shore up a lot of some of the problems that we've got with Social Security without having to do anything specific to touch those entitlements in that environment. So there's a lot of false information out there. Each side picks their way and they just go with it. I hope our tariff discussion at least gave you some scenarios to think through. It's not as bad, but it's also not as good either for things there, because the retailer doesn't have a lot of pricing power when it comes to raising prices, because in many cases the consumers have just said, I've had enough, or they just simply don't have the money to do it.
Shifting a little bit, Shashir, can you share some of the results that you have seen with your customers in achieving returns optimization?
Most definitely. I mean, we haven't put that in the slides, of course, but we have seen about 20 to 30% increase in, how inventory is getting optimized, and returns have been, reduced by 3 to 5%. Essentially, both how we are able to provide the inventory visibility across the enterprise, as well as being able to deflect returns and take in returns at the right place at the right time. So these were at much larger companies. So the dollar impact at the bottom line was huge, right? Even that 3 to 5%.
Okay. Concerning tariffs, how does that play into supply chains?
Well, I think it's going to force people to do more, even more to optimize their supply chains. I think that was happening already. I think there's a huge opportunity for route management and optimizing routes to lower cost. This is where AI is coming into play in a huge way. I think the biggest issue and biggest concern I have with a lot of retailers is their data is just not ready to take advantage of that things in the supply chain. Let's face it, retail, with all our foibles, we are still more efficient than just about any other industry when it comes to supply chain there. And I always argued that FEMA should be run by Walmart, Target, Home Depot, and Lowe's, and maybe Costco and Sam's in there, and then let the government just kind of get out of the way, because these guys know how to stage product and get it distributed very, very quickly there. But there is a lot of optimization that's still there. I mean, Walmart has saved 3% on their cost to store fixtures by using AI to negotiate. That's pretty astounding in and of itself. So there's a lot there that can be optimized still, but we're still, I think, the best in the world of all the industries at the supply chain.
Yeah. This is for both of you. What is the reason for retailer or manufacturer pushback to adopting size uniform?
I think it's an addiction again. I hate to keep using the term. Women are the primary shoppers of fashion products in particular. They would shop more at the place where they had the lowest size. It's vanity. And it's just like, well, and if we go to true sizing, we're going to lose all these customers who don't think they're a size 2 anymore. And it's just weird. But I think there's a lot of, when it comes to sizing, I think people are regretting that they didn't do it a lot sooner. It's kind of like raising a child, when they get to that launch point and you realize, man, I really wish I would have spent that time back there, imparting that piece of wisdom or doing something back there, because now they're not listening to me anymore, type of thing. But I think that's the challenge. We did all these things. And it was kind of during our desire for cheap merchandise as well. It was like, how do I squeeze a little bit more out while I make her feel better because the size is a little lower than my competitor, type of thing for that, or him. It's not just her, it's just the preponderance of shopping. So I think the pushback is, how do I do this? It's kind of what we did in tech when we went from on-prem to cloud. That was a tough nut to swallow at first, to take that hit there. And regardless of whether anybody agrees with it or not in the administration, this is one of those kind of things. These tariffs are one of those kind of things where you gotta make the tough call and hope you survive the tough call to get to the positive piece. That's my view of it.
So do I offer the IHL disclaimer now about the women's sizes and stuff?
If you want, I mean, it's truth is truth. I mean, this is how retailers have operated. Aspirational sizing has gotten them into this problem with the rise of e-commerce in particular.
Yeah. Shashir, this one's for you. What are some of the more interesting use cases for reverse logistics that you guys have run across?
That's a good one. I think what I would want to share is, let me tie it back with some things that Greg, you pointed out. Essentially, letting the customer keep the product, right? So two aspects there. So we started off with letting the customer keep the product because it's too costly for us to return back. Out comes Amazon with partnerships with UPS and FedEx and things like that, because they are already places where it's easy to consolidate a shipment and send it out to a warehouse. So that's one of the use cases that you can put in. Now you're suddenly having to onboard a partner as a return location. So, and as and when these new partnerships arises, the platform needs to be flexible enough to help in onboarding these onboarding these partners, make sure that the technology is aligned and there is seamless integration between the data flow. So that's one that we had to quickly rush in, roll out features and ensure that we are able to support those use cases. The other one, and not a lot of platforms are able to do, is in advanced exchanges. So instead of losing the customer and having them to, having to refund the product, it's all about showcasing, hey, what is the reason that you're returning? We talked about sizing, right? The size is not right. Can I send a different size? Why don't you do this? And we don't charge you until we receive the product, or the return, the refund money actually funds the new sales order. So that flow of, or the accounting of the refund to advance exchange and ensuring that the funds are not held for the customers and things like that. Those are the kind of customer experiences with advanced exchanges that we are able to enable as well. And those are like the two big, interesting use cases that I would say that we have seen.
This is one of the areas where AI, not only in the back end, but as a front end consumer side, can be hugely helpful. I don't know how many of you have a Sam's card out there, but Synchrony Bank's AI chatbot is the best I've ever seen anywhere. I misplaced my Sam's card the other day and I didn't know where it was. It happened to be in my wallet. That tells you how things are, but I found it when I went traveling, but I reported. I said, I've lost my card. I need to get it. I need to get a new card. The entire process took 45 seconds. It validated who I was, the last 5 transactions, were these legit, et cetera. What's my social security number? What's my zip code? All these sort of things. The whole thing happened in 45 seconds. And if you have that when it comes to returns, or you have that kind of speed to try to save the sale opportunity for somebody there, for instance, hey, it's the wrong size, and says, well, I can reserve the right size, the different size for you at the local store. Do you want me to do that? And to have the intelligence just to be able to do that to save that sale would be a huge thing. And then even offering an opportunity, if you wanted to add enough further incentive for coupon or anything else to allow them to shop in the store, because on average, somebody, if they get a credit, they spend 25% more of that once they're in the store itself. So AI can have a huge impact.
Let me add on to that, Greg. I mean, one of the use cases that we have brought to market is essentially use of AI, generative AI, essentially, in call center scenarios where customer is calling and saying, I want to return it. The agent is new, or the agent now has to go to a different system to find out of what policy applies and can they return it, how much with the restocking fees and all those things. And with our system, we can actually get the data from all of those disparate systems and provide it in a natural language chatbot way to the consumer directly, or to the chatbot, or to the CSR, and they can actually get approvals within that window itself if it needs to be approved at the supervisor and things like that.
Okay. Should we expect a shortage of devices like we saw a couple of years ago with chips, computers, OS devices, etc.?
I've seen conflicting information come out. I saw one thing that semiconductors are excluded from things. Now, I don't know if that includes memory as well as drives, because the memory comes from Korea, the drives come from Thailand, type of thing. I think the bigger issue is after a couple years of really downtime for PCs, we're about to see huge uptime and upside. And now the tariffs have kind of raised the price point for companies to do that because of Windows 10. The expiration of that was already driving the resale, or excuse me, the replacement market for laptops and things. And now I think in the stuff that's in stores or in stock right now that are not subject to the tariffs, they can just get it ordered, et cetera, as fast as possible. So it's going to be a bump for those folks. I think the bigger thing is the fact that the demand is going to be much higher than the supply. I will tell you that The disappointing thing has been in the last year is that demand hasn't been driven by running AI locally on your machine that everybody was talking about, like an AI PC. It hasn't occurred there. The expiration of Windows 10 and all of that is going to have a huge impact on replacements for theirs. But that's one of the things we got to get more information on, because it said that it was semiconductors were excluded, but yet when I turned CNBC on this morning, that's all they were talking about, is how this would impact this company or that company that's in the semiconductor industry.
Well, gentlemen, we're at 5 after.
So, okay. Well, thanks everybody, and thanks for your being the guinea pigs as we tried out this new thing. I just realized when I finally got to the chat that I can actually elevate a comment to the screen there. I wish I would have been able to and knew that beforehand, but really appreciate you guys taking the time. We've got another one of these coming up with Salesforce in a couple weeks. Would love to have you, but wanted to thank IBM for making this possible there, and Shashir for joining us today. And we'll send the recording as in cleaned up slides and all that fun stuff to you later today. Thanks, everybody. Have a good day.
Here, guys.
Thanks, everyone.